today, we'll be looking at creating a base project and a detailed project, and then diving into the differences between add backs and the concept of normalizing or normalization. And that will be useful to us as we start seeing what we call performance comparison, where we're going to transform the dollarized income statement into ratios that show us variations more clearly from year to year. So here I have a project, but let's start from scratch, shall we? Let's build a new project. We'll use TaxTract and we'll call this Webinar 2. And as you see, I've listed the company name and the project name automatically fills. Now the company name is the name of record, while the project name is the name that will be presented on the reports. And here I may want to redact information if I needed to. Here I have some exact information, but here in my project name, which I can edit always in the future, let's redact that. Let's call this a calculation of value. We'll go ahead and do this one in here. All right, so let's enter the 2023, 4, and 5, and we'll select the S Corporation, and we'll browse our files, and we'll pull up the 23 tax return. Now, when we're building a base project, we're focusing on the income statement. And in fact, there's only one page that we can upload in the base project. We've done that for 23. Let's select for 24. I can hover. I can still look and see what is the page that I want. And I know the income statement looks like this. So let's go ahead and save that. And now in our 25, we can double click, select the income statement, save it, and we can upload. TaxTract is going to create a project for us. Here it's saying that we've created a base project. It has some limited functionality, but it's a great screening tool, particularly for smaller projects or ones that I want to take a quick look at. Page 1, the income statement. And in a detailed project, we'll be reading additional information. So this is our source content. And let's go back to TaxTract and let's see that we have received that bell notification. So let's click on the data, and here we see our income statement for 23, for 24, and I open the year and I see that my variance is 0. That means that the information that we imported from the tax return that yielded ordinary business income of $107,000 by calculation is replicated here and compared to the number that was observed or read on the tax return that's presented here, so that our variance is 0. Then we'd want to look in and say, was there any error? Was there any data that was not clear that TaxTract was able or not able to read? We'll see some notifications, and we'll talk about that in a minute. Let's come to the 25, open it up, and we see all our data and our variance. We're trying to convey now what's a stabilized operating outcome. At times we call that a forecast, but what we're really saying is, given the historical performance of the company, let's try to stabilize that and reflect what would be a likely expectation for the business to continue into the future, given the same set of operating practices. We've developed a weighted average, meaning that here, 146,330 is the weighted average of these three numbers. The weighted average of SDE, 245, 246, 229, is 240. So we'll take these weighted averages and then also display them here. Revenue at $1,250,000, EBITDA at 146, SDE at 240,000. Then we'll apply a growth rate and say, this is what we think is a stabilized performance given the variability in the historical period. So now we have that same base project that I built in this platform. Now let's create a project. Let's use TaxTract. And now in the advisor platform, we're going to see some additional content here. And let's go in and say this is going to be the webinar that's propagated here. We're going to call this a calculation of value. And now we're going to build a detail project. Now here I could insert some information. For example, if I had a listing number, then we're going to say this is an asset sale Let's take those same years. Let's list the tax form, browse my file. Let's list the tax form, browse my file. We'll find that same. Now, when we are creating a detailed project, we can see that we can see all of the pages. Again, this is a condensed return. If I had 50 pages, this would have been there. I could find the income statement. Now I'm going to import the balance sheet. I'm going to import the Form 1125A, cost of goods sold. Let's come to the 24 and let's take the income statement. By experience, we know that that's the balance sheet. That's what the cost of goods sold form looks like. Let's go to the officer compensation and let's look at this officer compensation. And here you can see, although it may be in small font, that we have the actual owner's name. We will redact that name and it will be owner 1. So we'll never present personal information. Now we come to 25 and let's take those same pages, let's import that, and then we'll say, let's upload them. The beautiful thing about TaxTract is it solves a couple of problems for us. One, it solves the problem of time. We all can face a certain amount of dread saying, wow, I've got 3 BOVs to crank out, and it's so difficult to enter in numbers manually. So TaxTract will reduce that time demand and allow you to spend less time at the desk, and it will allow us to spend more time facing customers, sellers, and buyers. Secondly, it will increase the accuracy of information. We'll capture that information accurately, and if there were any errors, we'll also be able to see where they are. The data has been collected. Let's apply the data. So BizPro Value will automatically calculate EBITDA because that's a standard accounting equation. It will automatically calculate seller discretionary earnings because that's an automatic standardized equation. EBITDA plus officer compensation. Now, what may be different about BizPro Value is that we are normalizing at the account level. We're not simply adding back at the bottom line level. And that is immensely important and a huge differentiation that we'll address now. So now let's go to another project which we created previously right here, because I have 5 years worth of data and I have everything already normalized for us. So let's look at our normalizations and what we have done here. Rather than simply taking a bottom line add back, or by removing expenses such as officer compensation, interest, depreciation, discretionary expenses, and developing a unified ordinary business income, EBITDA, seller discretionary earnings. If I just have one number and they all equal $229,000, then my ordinary business income is overstated, my EBITDA is overstated, and seller discretionary earnings is true. That may be valid if we are basing the value of the business only and solely on seller discretionary earnings. But that removes a lot of power from us. It removes what could be the value if this was weighted on EBITDA versus seller discretionary earnings, or even revenue, depending on how we had normalized revenue. But since Pure Comps gives us multiples on revenue, EBITDA, and seller discretionary earnings, let's make sure that we normalize all three so we can get the most accurate and most appropriate indication of value based on the seller and who the buyer might be. So here you can see that we have made adjustments. One, I've taken this other income, and because I had interviewed the seller and found out that this income was actually permit and inspection fees. These are monies that were collected. They're payable to outside parties, a permit fee paid to a permitting agency or governmental organization. In this case, it was not presented as true operating income or revenue, but because we had expensed it later here, I want to remove it from other income into gross receipts and sales. And because I've interviewed the seller, my normalization or my adjustment can withstand the scrutiny of the bank underwriter. And I can explain, why did I make that adjustment? And the manner in which I made that adjustment was I entered a negative number here equal to this other income. I have an industry, and I can filter that industry by selecting the edit button and selecting the revenue range for the comparison group, a filtered set of the whole industry at a revenue range that's similar to my subject company. I picked $1 to $3 million because that was the revenue. $1 to $3 million is appropriate for my subject company. Now I have a comparison. Here I see that my EBITDA, now again, I did 5 years here, is significantly greater than the EBITDA of my comparison group. That might suggest to me that when I come to most probable selling price, I may want to sell this business at a premium. If it was just average, which is the default rating, and our multiple, our weighting suggests this business is worth $688,000. Because I have seen this performance comparison, and I've seen that my EBITDA is a significantly greater and on a fairly consistent basis, I could say this company earns more dollar per activity than the average company does. Therefore, I'll come here and I'll increase. We had 688,000. And now we'll say, let's put that at the 70th percentile. And here we have 762,000. We had 688 versus 762. That's a $74,000 swing, because we were able to look at performance comparison and say this company is performing significantly more profitably than the industry as a whole and the comparison group in detail. So the benefit of capturing, I think, 5 years worth of data, because it gives us a greater understanding, the benefit of normalizing the financial statement as opposed to simply adding back to a bottom line, is that it gives us a more accurate picture of company activity. And when we come to performance comparison, it can really show, in this case, a positive difference that this company is significantly more profitable. Therefore, when we come to most probable selling price, it's likely that I'll price this deal at a premium. I'll simply say thank you for joining us here today. As always, we're here to support your success, and we wish you the best and have a great week. Thank you very much.